Welcome back to the channel. Today, we're going to be looking at the question of, do technical indicators actually work for predicting stock prices? You know, it's a big one.
Yeah, it really is.
We've gotten a ton of research, some trading strategies, even some stuff about AI. So let's see if we can break it all down.
Sounds good. Well, one thing that really jumps out is that the answer kind of depends on the context, you know? Like a lot of the research suggests that these indicators can be profitable, but there's a catch. There are usually some specific conditions that need to be met.
Okay, so give us an example then. What kind of conditions are we talking about?
Well, one study we looked at focused specifically on emerging markets, specifically the BRICS nations. They actually found that a trading system that was based on moving averages actually beat a simple buy and hold strategy, in those markets at least.
Oh, so location matters.
Mhm.
Is that because those markets are less predictable?
Exactly. Emerging markets tend to be less efficient than, like, say, the U.S. market, for example, which means there might be more opportunities to, exploit those price patterns that pop up. It's not really about predicting the future. It's more about recognizing those inefficiencies.
Okay, that makes sense. What other factors are we seeing, though?
Well, another study we saw found that you could get better performance if you optimize the technical indicators for specific stocks. So it's not a one-size-fits-all approach. You really got to fine-tune things based on the stock, market conditions, all that.
So, like any tool then, I guess it's really about the craftsman, not just the tool itself.
Hmm.
But even if you optimize everything perfectly, are we talking consistent long-term profits here, or is this more of a short-term thing?
Yeah, that's the million-dollar question, isn't it?
Mm-hmm.
And the research isn't, totally clear on that one. There's definitely evidence for both sides. One study on the NYSE, for example, found that optimized indicators could beat a buy and hold strategy, but that was mainly in short-term trading.
Okay, so there is the potential there for quick gains. But what about those of us with a longer time horizon?
Well, that's where it gets a bit trickier. There was another study that we saw that looked at a broader range of indicators, things like moving averages, MCDs, RSI. A lot of them actually struggled to beat a buy and hold strategy over the long term, especially in those really well-established markets like, again, the U.S. stock market.
Right.
And you always got to remember, too, those transaction costs can really eat into profits, especially if you're doing all this frequent trading, based on these technical signals.
That's a really good point. It's easy to get caught up, in the excitement of spotting a pattern. But you've mentioned strategic use a couple of times now. What does that actually look like in practice?
Well, one really intriguing idea from the research is this idea of combining technical analysis with fundamental analysis. Rather than thinking of them as two separate things, some research suggests they can actually work really well together.
So it's not just about those price patterns then, it's about looking for some kind of confirmation in the company's financials. Would that be right?
Yeah, exactly. It's about using multiple tools to really get a more complete picture. And, technical analysis, it might be less about seeing the future and more about trying to understand investor psychology, the emotions that are actually driving those buy and sell decisions.
That's an interesting concept. Can you maybe explain that a little bit more?
Sure. So technical indicators are based on past price data, right?
Right.
Which really reflects past investor behavior. So by analyzing those patterns, you can kind of get a glimpse into the collective psychology of the market.
So it's more about understanding patterns of human behavior, not just like some magical formula for predicting the market.
Precisely.
Uh,
And that can be really valuable, especially in, volatile markets or emerging markets where sentiment tends to play a much bigger role. We also had some material about using AI for technical analysis.
Oh yeah, that's interesting. Is that like the next frontier here for trading? Could AI unlock the true potential of these indicators?
Well, AI and machine learning are definitely becoming more and more common in finance. I mean, they can process huge amounts of data, spot complex patterns, the kind of stuff that humans just, might miss. Imagine like algorithms that analyze not just historical data, but news sentiment, social media, even macroeconomic factors, all that going into generating trading signals.
Yeah, that sounds incredibly powerful. But I mean, are there risks involved in relying on AI for something as complex as investing?
Oh, of course, of course. AI is only as good as the data it's trained on, right? And there's always that risk of overfitting, where it might perform well on past data, but then totally fails when it encounters a new situation. So, yeah, AI can be a powerful tool, but it's definitely not a replacement for human judgment and knowledge.
Right. That seems to be like a recurring theme here. Like tools are important, but the investor's skill is really what makes the difference in the end. Speaking of tools, though, it seems like one of the challenges with technical analysis is just the sheer number of indicators that are out there.
Oh, absolutely. I mean,
Hmm.
you've got your moving averages, mass EDs, RSIs, stochastic oscillators, Bollinger Bands. It really goes on and on. For someone just starting out, it can be completely overwhelming.
Where do you even begin with all of that?
Well, I would say start with the basics. Focus on a few of the most widely used and well understood indicators.
Okay.
Like moving averages, they're relatively simple to grasp and can really give you a good basic sense of the trend.
Hmm.
Another good one is the RSI. It's a really popular momentum indicator that can help you identify overbought or oversold conditions.
So build a solid base before kind of venturing into more of that complex territory.
Exactly.
We also saw some discussion about candlestick patterns.
Hmm.
Are those still relevant today?
Yeah, candlestick patterns, they've been around for centuries. They actually date back to 18th century Japan. And some traders, they really swear by them. They believe that certain formations can signal market reversals or continuations.
But is there really any evidence to back that up?
The evidence it's a bit mixed.
Okay.
Some studies have shown a statistically significant impact on price movements, but others have found that they're really no more predictive than random noise. So, yeah, proceed with caution, I would say. Don't base your entire strategy on candlestick patterns alone.
So they might be like a helpful confirmation tool, but not the main event.
Yeah, I think that's a good way to put it.
Okay.
Yeah.
We also saw some pretty intriguing research on just the psychological aspects of technical analysis.
Yeah.
And you kind of mentioned how it might be more about exploiting market inefficiencies and investor psychology than it is about actually predicting the future.
Right. Technical indicators, they're based on the idea that patterns in price data, they tend to repeat themselves.
Hmm.
And a lot of times that repetition, it's driven by human behavior. Things like fear, greed, that herd mentality we see so often. And those emotions, they can create those predictable patterns in the market.
So by understanding these psychological drivers, then you can kind of anticipate how other investors are going to react and position yourself accordingly.
Yeah, exactly. It's recognizing that the market isn't always rational, and technical analysis can help you capitalize on those moments of irrationality.
Interesting. One of the studies we saw used decision trees to predict stock movements.
Oh, decision trees. That's an interesting approach.
Yeah, they actually used a whopping 22 technical indicators as input for those models.
Wow, 22. Okay.
And they tested it on 6 different high market capitalization companies from the National Stock Exchange of India.
Okay. So a pretty diverse set of companies there. What were the results? Did the decision trees actually work?
Well, the models achieved an accuracy of around 85% in predicting market behavior.
85%. That's pretty impressive.
Yeah.
So it does seem like decision trees could be a pretty valuable tool for technical traders, especially in a market like India.
But they did say that even with that level of accuracy, managing risk exposure is still really crucial.
Yeah.
No model is perfect.
Of course. Of course. And did they mention anything about specific indicators that were particularly useful?
They did. They actually highlighted the relative strength index, the RSI,
Okay, the RSI.
as being a particularly useful tool.
Yeah.
Measures those magnitude of recent price changes.
Right.
So you can evaluate overbought or oversold conditions.
So, for example, an RSI above 70 might signal a potential correction. Possibly a sell signal. And conversely, an RSI below 30 could suggest the security is oversold.
Right.
So potentially poised for a rebound. So it'd be a buy signal.
Exactly.
Interesting.
And the researchers really emphasize that these decision trees can help streamline, the process of analyzing those signals and making those trading decisions.
Yeah, that makes sense. I mean, that kind of automation, it could save traders a ton of time and effort, potentially leading to, more objective, data-driven trading decisions. Emotions can be a trader's worst enemy, right?
Yeah, absolutely. There was also some research about evolving and combining technical indicators. Have you seen that?
Oh, evolving indicators. That's intriguing. I'm definitely curious to hear more about that. Tell me about that.
Well, this study, they used a genetic algorithm to optimize the parameters of various
A
indicators.
genetic algorithm. So it's like survival of the fittest, but for trading indicators.
Exactly.
Like that.
Yeah. So it starts with like random indicator settings, tests them against historical data, and then it selects the ones that perform the best. And then those winners, they create a new generation of indicators, and the process just keeps repeating, getting closer and closer to those optimal settings.
Oh, clever. How effective was it, though?
Well, they tested it on stocks from the Stock Exchange of Thailand,
Hmm.
and they actually found that those evolved strategies consistently outperformed other well-known techniques. It really shows how important it is to adapt your strategies as the market changes.
Right, right. Constantly monitoring and adjusting is key. And did they look at any specific types of indicators or combinations?
They did. They also explored decision trees, specifically the chi-square automatic interaction detector algorithm, or CHAID for
The
short,
sheet algorithm.
for combining multiple indicators.
Okay.
So instead of just relying on one indicator, they used a combination of signals to make those buy and sell decisions.
Interesting. And how did that approach perform?
It actually proved to be very effective. You're essentially reducing the risk of a single potentially flawed signal.
Right, right. And you're getting a more nuanced, a more comprehensive view of the market.
Exactly. And this research, it really shows the potential of these more advanced techniques like genetic algorithms and decision trees for really enhancing technical analysis.
Yeah, it's a good reminder that there's always room for innovation and that new technologies can potentially give traders a real edge. But, not all of the studies were quite so positive about technical analysis.
Right.
One that we saw analyzed I think it was 93 market indicators, including some sentiment proxies that are used in behavioral finance. And they really wanted to see if these indicators could reliably predict future stock returns.
And what did they find?
Well, unfortunately, they didn't find any evidence of consistent predictability
Ooh.
for future stock returns.
Hmm.
But it's really important to note here that this study, it focused on the U.S. stock market, which is, arguably one of the most efficient markets in the world.
Yeah.
So it's possible that technical indicators might be more effective in less efficient markets.
Right. It's that market efficiency idea again.
Exactly.
Okay.
And they also didn't account for what's called state-dependent predictability. So an indicator's effectiveness, it might actually change based on the overall market state. Like an indicator might be more reliable during periods of high volatility or certain phases of the business cycle.
So context is still crucial.
Absolutely.
Okay.
They also stress the importance of economic significance. Even if an indicator shows statistical significance, that doesn't necessarily mean it's going to be profitable after you factor in things like transaction costs and risk.
Right. So a statistically significant result isn't really useful if it doesn't translate into real-world profits.
Exactly. It's about going beyond just the statistical significance and really thinking about those practical implications.
Okay. Another study we saw, this one focused on the Indian stock market. And they were examining the effectiveness of various technical indicators in predicting price movements of large cap, mid cap, and small cap companies that were listed on the Bombay Stock Exchange.
Okay, so a pretty broad range of companies there. What indicators were they looking at?
Well, they analyzed quite a wide range,
Okay.
including moving averages, the stochastic oscillator, the RSI, and the MET indicator.
Okay, and what were their findings? Were those indicators helpful?
They found that those indicators could definitely be helpful in analyzing price movements and generating signals.
Okay.
But their effectiveness, it really could vary depending on the specific stock and the overall market conditions.
So once again, context is key.
Yeah. They also stressed the importance of combining multiple indicators, to get a more comprehensive view of the market.
Yeah, it's like getting a second opinion before you make a big decision.
Exactly. They also pointed out some limitations, though.
Okay, what kind of limitations?
For example, moving averages can be a bit slow to react to sudden price changes.
Right.
So they might lag behind a bit in those fast-moving markets. And then the stochastic oscillator, it can sometimes generate false signals during non-trending periods.
So it's all about using them strategically and understanding their limitations.
Absolutely. They also discuss the RSI and how it can sometimes stay in overbought or oversold territory
Yeah.
for a while, even when even when a price reversal is coming.
Right. So it's important to use it with other indicators, not as a standalone signal.
Right. And with the MAN-CD indicator, they noted that it's particularly useful for identifying changes in the direction and the strength of a trend.
Okay.
So it could be really valuable for traders who are looking to ride momentum.
It sounds like there's no one size fits all approach to technical analysis,
Yeah.
and traders really need to find what works best for them. Did they have any specific recommendations in terms of how to approach this?
They did. They recommended combining simple moving averages and exponential moving averages,
Mm.
or SMAs and EMAs, as they're often called, for more reliable signals.
Okay.
SMAs are slower to react to price changes, while EMAs are more sensitive. So using both, provides a more balanced view.
Right. Right.
They also suggested considering the overall market trend before making any decisions, and cautioned against relying too heavily on any single indicator.
Yeah. Diversification is key, even when it comes to technical analysis.
Right. Now, there was a research paper that we thought was really interesting. It examined the profitability of technical analysis based on moving average strategies
Okay.
in the BRICS
The
nation.
BRICS nations. Okay.
So they created a portfolio that contained assets that were traded in each BRICS market.
Okay.
And they developed an automated trading system
Yeah.
that actually simulated transactions using these technical analysis techniques.
Oh, interesting. So they basically built a trading bot. How did it perform?
Well, the returns that were obtained by this automated system, on average, they exceeded the value that was invested. Wow. Which suggests that these automated systems, they couldn't even be really worthwhile, especially in those BRICS markets.
It seems like that market efficiency thing really plays a big role in how effective technical analysis can be.
Yeah, less efficient markets, they just present more opportunities for technical traders.
Makes sense.
And they also found that certain assets, they performed significantly better than the portfolio average, even surpassing buy and hold returns.
So picking the right assets within the market is also important.
Right.
Did they find that certain markets within the BRICS group were particularly promising?
Yeah, they saw particularly strong returns in the Russian and Indian markets,
Okay.
which could be due to market volatility, investor behavior, regulatory differences, all sorts of factors.
Makes sense. Makes sense. And this study also found that technical analysis could actually complement fundamental analysis
Right.
by helping to identify the most dynamic companies. So instead of being like competing approaches, they can actually work together.
Exactly.
Yeah.
Imagine using technical indicators to spot companies with strong momentum, strong price trends.
Yeah.
And then, you dig deeper into their fundamentals to see if that momentum is actually justified.
Right. So it's not just about, chasing price movements.
Yeah.
It's about making sure there's something real behind it.
Exactly. The study also went into detail about the moving averages that were used in this automated trading system.
Okay.
And they actually used a combination of short-term and long-term moving averages
Okay.
to generate those buy and sell signals.
So for example, like a common strategy is to buy a stock when its short-term moving average crosses above its long-term moving average,
Right.
signaling a potential upward momentum shift.
Right. And then you would sell when the short-term average crosses below that long-term average.
Exactly.
Okay. And the study found that this simple strategy, when applied systematically, it could actually generate some pretty significant returns in those BRICS markets.
Interesting. Sometimes the simplest strategies are the most effective. What about the impact of transaction costs, though? I mean, did they factor that in?
They did. They actually found that transaction costs, they significantly impacted the performance of their trading system,
Okay.
which highlights the need to really be mindful of those costs when you're developing your trading strategies.
Of course. And I imagine the optimal range of moving averages to use could also vary depending on the specific market and those transaction costs.
Absolutely. So tailoring your approach to the specific context, remains really crucial. This research, it really shows the potential of technical analysis in emerging markets,
Yeah.
especially when you're considering things like market efficiency, those transaction costs, and really the interplay between technical and fundamental analysis.
Right, right. It's not about just blindly following indicators. It's about using them intelligently as part of a much more comprehensive investment approach. We also saw another study that focused on emerging markets. This one specifically on the Egyptian stock market,
Okay.
and they looked at a momentum-based trading rule that was applied to the most active stocks that were listed on the Egyptian exchange.
Okay. What did they find?
Well, they found that the momentum-based strategy, it actually generated some pretty positive returns,
Hmm.
especially during periods of high volatility.
Oh, interesting.
So it suggests that even in emerging markets, there are definitely times when technical analysis can provide an edge, really reinforcing that idea that market conditions play a crucial role.
Hmm. Did they say anything about like the why, why it might be more effective during those periods of high volatility?
Yeah, they actually touched on the idea of market psychology,
Okay.
suggesting that the success of that momentum-based strategy might be because investors, they tend to overreact to news, especially during those periods of high uncertainty.
So in those really chaotic moments, a calm and collected trader, they could use this momentum play to their advantage.
Exactly. They also highlighted the importance of risk management, of course, which is always crucial, but especially important when you're using technical analysis.
Right. Because technical analysis relies on the assumption that those past price patterns are going to repeat themselves.
Right.
But there's always the risk that they won't,
Of course, of course.
which can lead to, significant losses if you're not careful.
Absolutely, absolutely. One study that we found really interesting, they used a machine learning technique called a support vector machine, or SVM, to predict stock price movements.
Okay.
And they trained this SVM model on a data set of historical stock prices and technical indicators to classify those stock price movements as either up or down.
So they're using machine learning to essentially make a prediction, but how accurate was it? Did it actually work?
Well, the SVM model, it actually achieved a really high level of accuracy in predicting those stock price movements.
Hmm. Impressive. So it sounds like machine learning really could be a game changer for technical analysis.
It has the potential, that's for sure.
Yeah. Did they mention anything about specific challenges or things to keep in mind when you're using this approach?
Yeah, they emphasize the importance of what's called feature selection.
Okay.
So choosing the most relevant variables, and that's to avoid overfitting, which is, when your model it learns the training data too well, but then it doesn't generalize to new data.
So it's like uh, studying for a test by memorizing all the answers, but not actually understanding the concepts.
Exactly. Exactly.
Yeah.
And by carefully selecting those features, they were able to actually improve their model's accuracy. So it really shows that it's not just about throwing a bunch of data at a machine. It's about choosing the right inputs.
Right. Another area that we saw some research on was the cryptocurrency market.
Ah, crypto, that's a whole other world, isn't it?
It is, and this study examined the profitability of using moving average crossover strategies
Okay.
to trade Bitcoin.
Straight Bitcoin. Okay. And did they find any consistent profits?
Well, the results were a bit mixed. While some moving average combinations they were profitable, others actually resulted in losses. So it's not a guaranteed path to riches in the crypto world.
It seems like the cryptocurrency market, it might be a tougher one to crack for technical traders.
Yeah, I think you're right. It's still a relatively young market. It's illiquid.
Right.
It's more susceptible to manipulation and sudden price swings. So, those traditional technical analysis techniques, they might not be as effective in this kind of environment.
Yeah, that makes sense. Did they look at any other indicators besides moving averages?
They did. They also look at the RSI and the Mass ED to see if they could be used to trade Bitcoin.
Okay. And how did those indicators perform?
Again, mixed results. Some performed better than others, but none of them consistently generated significant profits.
So while it's not impossible to profit from trading cryptocurrencies, traders really need to be extra cautious and do their research.
Yeah.
Perhaps they need to explore some new approaches that are really tailored to the unique characteristics of the cryptocurrency market.
Right. Now, shifting gears a bit, there was also a study that focused on the forex market.
Yeah.
The foreign exchange market,
Okay, Forex.
which is the largest and the most liquid financial market in the world. And they examined the effectiveness of combining technical indicators and machine learning
Okay.
to predict exchange rate movements.
Okay. And what kind of machine learning techniques were they
They
using?
used a neural network,
A neural network.
which is a type of machine learning model that's inspired by the human brain.
Right, right. Neural networks are known for being able to learn those complex patterns.
Hmm.
So what were the results? Were they able to predict those exchange rate movements?
They were. The neural network actually accurately predicted those exchange rate movements with a high degree of accuracy.
Wow. So it seems like machine learning really could be a valuable tool for Forex traders as well.
Yeah, and the study also highlighted the importance of using a combination of indicators
Okay.
and carefully selecting the most relevant ones for each currency pair.
Right. So it reinforces that idea that context is everything.
Exactly.
Okay.
This research suggests that even with its complexity, the forex market, it can be predictable to some extent.
Hmm.
And by combining technical analysis with machine learning, traders can potentially gain an edge.
Makes sense. Another study that we looked at focused on the use of technical indicators for short-term trading strategies.
Great.
And they examined some popular indicators like moving averages, RSI, and MACD, and they used a backtesting approach. So they were applying those trading strategies to historical data to see how they would have performed.
So it's like running a simulation, to see if your strategies would have actually been profitable.
Exactly, exactly.
What did their research reveal?
Well, they found that certain technical indicators they could definitely generate positive returns for short-term trading
Sure.
when they were used correctly, of course. But the success, it really depends heavily on the specific indicators you use, the time frame, and the risk management techniques.
So it's not just about picking a few indicators and buying and selling. It takes skill, it takes discipline, a really deep understanding of the market.
Absolutely, absolutely. They also noted that transaction costs can significantly impact the profitability of those short-term strategies.
Right, especially when you're making those frequent trades.
Exactly, exactly. Of course, they also emphasize that even the best indicators, they can't predict the future with 100% accuracy. There's always risk in trading.
Right, right. So this study provides some valuable insights for those who are interested in those short-term strategies,
Hmm.
highlighting the potential rewards, but also the risks that are involved.
Right, right. Yeah.
And it really underscores the importance of thorough research.
Yeah.
Having a solid trading plan and effective risk management.
Absolutely. Now, let's talk about a study that really examined the role of investor psychology in technical analysis.
Okay.
And this one really focused on behavioral finance, so exploring those psychological factors that are behind financial decision making. What did they find?
Well, they found that a lot of those patterns that technical analysts look for in price data,
Hmm.
they can actually be explained by investor psychology.
Oh, interesting. Okay, so for example, like the classic head and shoulders pattern,
Right.
which is often seen as a bearish signal,
Yeah.
that can actually be interpreted as a reflection of shifting investor sentiment.
Okay, so the pattern itself, it's not like some magical force. It's
Right.
really just a visual representation of how traders are actually feeling.
Exactly, exactly. As the price rises and forms the left shoulder, investors they're feeling optimistic, they're buying aggressively, and then as the price falls and forms the head, some investors they start to lose confidence, they start selling.
And then as the price rises again to form the right shoulder, those who are still bullish,
Yeah.
they try to buy back in.
Right.
But their buying power is weaker this time.
Exactly, exactly. And then as the price breaks below the neckline, that triggers a wave of selling as those who are, still holding on, they finally give up.
Right. So it's all about those emotions, that fear, that greed, that's driving those price movements.
Exactly, exactly. And the study also explored other psychological phenomena like herd behavior, the tendency to follow the crowd,
Right.
and confirmation bias,
Yeah.
that tendency to seek out information that confirms our existing beliefs.
Right.
And both of those biases, they can really impact technical analysis. For example, if you've got a lot of traders who are using a particular indicator
Hmm.
and it seems to be working. Others might just jump on the bandwagon,
Right.
even if they don't, fully understand how it works or why it's working.
Right. That's that herd behavior in action.
Exactly. Or if a trader is already bullish on a particular stock, they might interpret any technical signal as bullish,
Well,
even if there's contradictory evidence.
so that's confirmation bias at work.
Exactly. So this study really emphasizes the importance of recognizing our own psychological biases when we're using technical analysis. It's a reminder that we're not always rational in the market,
Mm.
and our emotions can sometimes lead us astray.
Yeah, very true. Um, Another study we saw investigated the profitability of candlestick patterns in the Indian stock market.
Candlestick patterns. So those visual representations of price action, right?
Right, right.
They actually originated in Japan centuries ago,
Hmm.
and they're still widely used by traders today.
Hmm.
But do they actually work? Is there any real evidence to support their use?
Well, that's what this study aimed to find out, and they focused on 16 candlestick patterns,
Okay.
and they applied them to stocks that were listed on the National Stock Exchange, the NSE of India.
Okay. And what did they find? Were those patterns, were they actually profitable?
They found that those patterns had a really high success rate.
Oh, okay.
Um, 11 of the patterns showed around 72% accuracy.
Wow, 72%. That's pretty significant.
Yeah, suggesting that there might be, some validity to these ancient patterns.
Interesting. Did they mention any specific patterns that were particularly reliable?
Yeah, they highlighted patterns like the bullish engulfing and the bearish engulfing patterns,
Yeah.
which are often seen as strong signals of a potential trend reversal.
Okay.
And they also found that combining those candlestick patterns with other indicators like moving averages and the RSI, it could actually further improve the accuracy of those trading strategies.
Right, right. So it's kind of like that idea of like getting a second opinion,
Hmm.
combining multiple signals. It often increases the reliability of those trading decisions.
Exactly. And this research, it really provides some valuable insights for anyone who's looking to incorporate those candlestick patterns into their analysis.
Mhm.
Suggesting that they can be a valuable tool for identifying those potential trading opportunities.
Right, right. But like any technical analysis technique, it's important to use them judiciously
Hmm.
and in conjunction with other forms of analysis.
Absolutely. Another study we saw, this one examined technical analysis in the commodity futures markets.
Commodity futures. Okay, so we're talking about raw materials like oil, gold, agricultural products,
Right.
all those things that are traded on futures exchanges,
Hmm.
where those contracts are bought and sold for future delivery.
Exactly.
And technical analysis is often used to try to predict those price movements in these markets. What was the focus of this particular study?
They investigated the profitability of using moving average crossover strategies to trade a variety of commodity futures.
Okay. And were they profitable across all commodities, or did they find that certain commodities were more predictable than others?
Well, the results were actually kind of mixed.
Hmm.
Some commodities like gold and crude oil, they showed pretty consistent profitability
Hmm.
using these strategies, but others like corn and soybeans, they were much less predictable. So, the effectiveness of technical analysis, it can really depend on the specific commodity that you're looking at.
Right, right. I mean, each commodity has, its own unique supply and demand dynamics.
Hmm.
So it makes sense that some would be more predictable than others.
Right. They also found that the optimal moving average parameters, they actually differed across commodities.
Okay. And did they highlight any other important considerations for commodity traders?
They did.
Yeah.
They really highlighted the importance of of risk management when you're trading in these, volatile commodity futures
So
markets.
of course, it's easy to get carried away by those potential price moves.
Right, right. And they recommended setting stop loss orders to really limit those potential losses.
Right, right. So a stop loss order, it essentially protects your capital from a sharp decline.
Exactly. This research really provides some valuable insights for anyone who's interested in those commodity futures markets,
Hmm.
suggesting that technical analysis can be profitable, but it really emphasizes the need for careful analysis,
Yeah.
risk management, and really understand those unique characteristics of each commodity.
Right, right. It's not just about blindly applying the same techniques across the board.
Hmm. Now, there was a pretty comprehensive study that we saw that analyzed the effectiveness of technical analysis across a variety of different asset classes.
Okay, different asset classes. So stocks, bonds, currencies, commodities. We're talking about the whole gamut here.
Yeah, exactly. And they examined a vast data set of historical prices for all of those different asset classes,
Mm.
and they really wanted to see if there was any evidence that technical analysis could consistently outperform a simple buy and hold strategy.
Okay. And what did they find? Were they able to uncover any evidence to support, the use of technical analysis?
The results were actually not very encouraging. While some technical trading strategies were profitable, in certain markets and certain periods,
Hmm.
none of them consistently outperformed buy and hold over the long term.
So does that mean that technical analysis is useless?
Well, not
Uh,
necessarily.
okay.
The researchers, they acknowledged that their study did have limitations.
Okay.
For example, they didn't account for state-dependent predictability.
Hmm.
That idea that a strategy's effectiveness might change based on the overall market environment.
Right, right. Like
No,
we were talking about earlier.
exactly. They also didn't consider the impact of transaction costs, which can eat into those
Of
profits.
course, of course.
So they suggested that future research should really explore those factors in more detail.
Right. So it's possible that by accounting for those market conditions and transaction costs, we might find more evidence to support the use of technical analysis.
Absolutely. They also highlighted the importance of risk management, especially for technical traders who are relying on the assumption that those past price patterns are going to repeat.
Right, right. That's a crucial point. And what did they recommend for managing risk?
Well, they recommended things like using stop loss orders, diversifying your portfolio, and only risking a small percentage of your capital on any single trade.
Right, right. So those are all really sound risk management principles.
Hmm. So this study really serves as a reminder that while technical analysis can be, a useful tool, it's important to use it wisely,
Hmm.
with a healthy dose of skepticism,
Right.
and to always prioritize risk management.
Absolutely. One study that we found particularly interesting looked at the use of artificial intelligence
Huh.
or AI in technical analysis.
Okay, so they're using AI to basically try and predict the market.
Exactly. This study investigated using machine learning algorithms to predict stock price movements.
Okay.
And machine learning, it involves training these algorithms on massive data sets
Hmm.
to identify patterns and mirror predictions. And in this case, they were trained on historical stock prices and technical indicators. What were the results? Were they able to predict those stock price movements?
They were. They actually found that these AI-powered systems, they could predict uh, stock price movements with a high degree of accuracy. They can process vast amounts of data. They can identify patterns that humans might just miss.
Right, right. It almost sounds too good to be true. So is AI the future of technical analysis? Is this the holy grail that the traders have been searching for?
Well, it's certainly possible, but there are some potential downsides to using AI for trading as well.
Okay, like what? What are some of the potential risks or drawbacks?
Well, for one, these systems can be incredibly complex
Right.
and difficult to understand. It's often called the black box problem. You might not know why the algorithm is making a particular prediction,
Right.
which can make it, difficult to really trust the system.
Hmm.
And there's also the risk of overfitting.
Right, right. That we were talking about earlier, where the algorithm performs well on past data, but then it fails on new data,
Right. Yeah.
which could lead to really poor performance in live trading. So it sounds like it's a powerful tool,
Mm-hmm.
but one that requires a lot of caution and understanding.
Absolutely. Um, Another study we saw examined the use of technical analysis in the bond market,
Bond market, okay.
which is often seen as more stable, less volatile than the stock market.
Right, but it's still subject to price
It
fluctuations.
is, and they investigated the profitability of using moving average crossover strategies to
Yeah.
trade U.S. Treasury bonds,
U.S. Treasury bonds.
which are considered one of the safest investments in the world.
Right, right. And what did they discover? Were those strategies, were they actually profitable?
They found that certain moving average combinations they could generate positive returns when they were applied to those Treasury bond futures.
Okay. So it seems like technical analysis, it can be effective,
Hmm.
even in those relatively stable markets.
Right, but they also found that the optimal moving average parameters they differed depending on the bond maturities that were being traded.
Right, right. Because shorter term bonds tend to be, more volatile than longer term bonds.
Exactly, and they also emphasized the importance of understanding those macroeconomic factors that influence bond prices.
Right.
Things like interest rates, inflation, economic growth.
Right, because those factors can really significantly impact, bond yields and prices. So it seems like even in the bond market, it's important to integrate that fundamental analysis into your technical trading decisions.
Right. Um, let's see. Another study that we looked at investigated the use of technical analysis in the options market.
Options. Okay.
So options, they're financial derivatives. They give the holder the right to buy or sell an asset at a specific price.
Right, right.
And they're often used for speculation and hedging.
Yeah.
And technical analysis can be used to try and predict those price movements in options contracts.
What did this particular study explore?
Well, they examined the profitability of using various technical indicators to trade options on the S&P 500 index.
Okay, the S&P 500. So that's a broad-based index of 500 large cap U.S. companies.
Right.
What did the study find? Were those indicators effective?
They found that certain indicators like the RSI and the Bollinger Bands, they could actually help identify potentially profitable options trades.
Okay, and did they mention any specific considerations for options traders?
They did. They highlighted the importance of understanding what are called the Greeks,
Greeks. Okay.
which are these key variables that measure an option's price sensitivity to changes in various factors. So things like the price of the underlying asset, the time to expiration, and volatility.
Right, right. So those are all really important factors to consider when you're trading options.
Hmm. And of course they emphasize the importance of careful risk management when you're trading options, because options trading can be highly leveraged.
Right, right. It's possible to lose more than your initial investment.
Hmm.
So this research suggests that technical analysis can definitely be helpful in the options market,
Hmm.
but it's crucial to understand those unique characteristics of options contracts and to really manage that risk effectively.
Right, right. Now, let's switch gears a bit and talk about a study that examined the use of technical analysis in the real estate market.
The real estate market. Okay, that's an interesting one. I wouldn't have thought to use technical analysis for real estate. What was their focus?
Well, they focused on using technical indicators to predict price trends in the residential housing market.
Okay. And what were their findings? Were they able to identify any reliable patterns?
They discovered that certain indicators like moving averages and momentum oscillators,
Hmm.
they could help identify potential buying and selling opportunities.
Mm.
So it seems like technical analysis, it really has wide applications across, a variety of different asset classes.
Yeah, it's amazing how these same principles they can be applied to so many different markets. Did they mention anything about about the psychological factors that might be at play in the real estate market?
They did. They actually noted that psychological factors, they influence the real estate market just like any other market.
Right, right. I mean, fear and greed can definitely drive prices up or down in real estate.
Absolutely. And they emphasized the importance of considering those psychological factors when you're using technical analysis for real estate decisions.
Right, right. So once again, it's not just about the numbers. It's about understanding, the human element.
hmm This research really suggests that technical analysis, it can be a valuable tool for real estate investors,
Hmm.
as long as they use it in conjunction with other forms of analysis, like fundamental analysis and market research.
Right, right. It's about getting that holistic view.
hmm What about the art market? Is there any application of technical analysis in the art world?
That's a good question. I mean, the art market, it seems like it would be, so subjective, driven by taste and perception. I'm not sure if technical analysis would really apply there.
Well, actually, there was one study that looked at that. They examined the use of technical indicators to identify price trends in the market for fine art.
Oh, wow. Okay. And what did they find? Were they able to identify any patterns?
They found that even in a market that's driven by taste and perception, there are underlying patterns that can be identified using technical indicators
Yeah.
like moving averages and relative strength. And they were actually able to identify periods of overvaluation and undervaluation in the art market.
Oh, that's fascinating. So even in such a subjective market, there are still quantifiable patterns.
Exactly. And they also noted that economic cycles and investor sentiment, they impact the art market just like any other market.
Right, right. I mean, when the economy is booming, people have more disposable income, for luxury goods like art. And when the economy is weak, art prices, they tend to suffer.
hmm This research really suggests that technical analysis, it can be a valuable tool for art collectors and investors. But again, it needs to be used in conjunction with a deep understanding of the art market.
Of course, of course. It's about combining that quantitative analysis with that qualitative understanding.
Right. Now, shifting gears a bit, let's talk about a study that really examined the role of education in technical analysis, because there's so much misinformation out
Yeah,
there.
absolutely. I mean,
Yeah.
it's easy for novice traders to make costly mistakes if they don't have the proper knowledge.
Right. And this study, it investigated the impact of formal education in technical analysis on trading
Okay.
performance.
So they wanted to see if formal training actually, made a difference.
Right. And what did they find? Did formal education, actually lead to better trading results?
Well, they found that traders who had formal training in technical analysis, they consistently outperformed those who didn't.
Hmm.
And they also found that the level of education was correlated with profitability.
Yeah.
So basically, the more you learn, the better your chances of success in trading.
Exactly. Exactly. They also highlighted the importance of continuing education,
Mm-hmm.
because markets are constantly evolving,
Mm-hmm.
and traders really need to stay up to date on the latest techniques and
Well,
strategies.
of course, of course. It's a field that requires, continuous learning and adaptation.
Right. This research really underscores the value of investing in your own education as a trader, whether it's through formal courses or books or online resources.
Right. The more you learn about technical analysis, the better equipped you'll be to navigate the markets. Speaking of navigating markets, what about venture capital?
I-
Is there any place for technical analysis in that world?
Well, one study actually explored that very question, challenging the notion that technical analysis isn't really relevant in venture capital.
Mm-hmm.
And they used technical indicators to identify potential investment opportunities in the private equity market.
Okay. And what did they discover? Were they able to find any promising companies using these indicators?
They found that indicators like momentum and relative strength could actually help identify companies that were poised for growth.
Hmm. So even in the world of startups and venture capital, there are still those underlying patterns that can be identified.
Right. So technical analysis, it can help you spot those potential winners
Yeah.
even in the earliest stages of a company's development.
Interesting, interesting. And this study also noted that the private equity market, it's influenced by investor sentiment and macroeconomic factors, just like any other market.
Right, right. When the economy is strong, investors are more willing to take risks on those early stage companies.
Hmm.
And when the economy is weak, you know, funding tends to dry up.
Right, right. So this research suggests that technical analysis, it can be a valuable tool for venture capitalists, but it's important to use it, along with other forms of analysis like due diligence and market research.
Right. It's about getting that complete picture.
Exactly. Now let's shift our focus to the high frequency trading or HFT industry,
Okay.
which uses algorithms to execute trades at extremely high speeds.
Right, right. It's a very controversial practice.
Yeah.
I know some argue that it gives those HFT firms an unfair advantage.
Right.
And one study actually investigated the use of technical indicators in those HFT algorithms.
Okay. And what were their findings? Were they able to identify any specific indicators that were commonly used?
They found that indicators like moving averages and order flow imbalances were very frequently used in these algorithms.
Okay, order flow imbalances. So that's where there's a significant difference between the buy and sell orders
Right,
and HFT algorithms. They can exploit those imbalances to generate profits.
right.
Interesting. And this study also highlighted the importance of speed in HFT. Where those algorithms have to process information and execute trades in milliseconds.
Right, right. It's a cutthroat environment where even a millisecond can make a difference.
Absolutely, absolutely. This research really it offers a glimpse into the world of HFT
Mm.
and the role of technical analysis in this rapidly changing field.
Hmm.
And it also raises some interesting questions about fairness and transparency
Hmm.
in these high-speed trading strategies. What about market making?
Okay.
Is there a place for technical analysis in that field?
Well, market makers, they're the firms that provide liquidity to the markets, right? By continuously quoting bid and ask prices for securities.
Right, right. So they ensure that there's always a buyer and a seller.
Right.
Okay.
And one study actually looked into how market makers use technical indicators to set those bid and ask prices.
Okay. And what did they discover? Were they able to identify any patterns there?
Well, they found that market makers often use technical indicators like moving averages and support and resistance levels to inform their pricing decisions.
Support and resistance levels. So those are price points where an asset has historically had difficulty breaking through.
Right. So even these sophisticated market participants, they rely on technical indicators.
Interesting. And did they mention any other important considerations for market makers?
They emphasize the need for speed and efficiency.
Yeah.
Because market makers, they have to adjust those prices very quickly,
Yeah.
in response to changing market conditions.
Right. Right. I mean, it's a very dynamic environment
Mm.
where those quick reactions are key.
Right. Another area that we saw some research on was portfolio management,
Portfolio management. Okay.
which is the art and science of selecting and managing investments to achieve specific financial goals.
Right. Right. And this study it examined the performance of portfolio managers who use technical analysis
Mm-hmm.
compared to those who don't.
Right. And they wanted to see if incorporating technical analysis actually made a difference in their performance.
Okay. And what did they discover?
They found that portfolio managers who use technical analysis, they actually tended to generate higher risk-adjusted returns.
Oh, interesting. So it seems like technical analysis can actually add value to portfolio management. How did those managers incorporate technical analysis into their strategies?
Well, they used it to identify stocks that had strong momentum,
Okay.
to time those entry and exit points for trades,
Mhm.
to manage risk by setting those stop loss orders,
Right.
and to diversify
Mm.
across different asset classes.
Right. Right. So they were essentially using technical analysis for a variety of different purposes within their portfolio management strategies.
Exactly. And the study also highlighted that the most successful portfolio managers, they used a combination of technical and fundamental analysis,
Mm-hmm.
which, once again, it really emphasizes the the value of having that holistic view of the market.
Absolutely. Now, what about the use of technical analysis in financial forecasting?
All right.
So financial forecasting, it involves using historical data and statistical models to try and predict future financial performance. And it's a crucial part of, corporate finance, investment analysis, economic forecasting.
Hmm.
And this particular study, it investigated the use of technical indicators to forecast corporate earnings.
So they were trying to see if they could actually, accurately predict earnings using technical indicators.
Exactly.
Yeah.
Exactly. And were they successful? Could they actually do it?
They actually found that certain indicators like moving averages and momentum oscillators,
Mm.
they could indeed predict future earnings with a reasonable degree of accuracy.
Hmm.
So it seems like, technical analysis could be applied to more than just price data.
Right, right. So we're not just talking about predicting, stock prices or exchange rates. We can also use these techniques to try to get a sense of a company's future earnings.
Right. But they also found that the accuracy of those forecasts, it varied depending on the specific indicator that was used and the industry that was being analyzed.
Right, right.
Yeah,
Makes sense. I mean, different industries, they have different business cycles, different growth patterns.
exactly. So while technical analysis can be a valuable tool for forecasting corporate earnings, it's essential to use it alongside other forecasting techniques like fundamental analysis and industry research.
Right, right. So once again, it's about getting that holistic view.
Mm-hmm. Now, what about risk management? Can technical analysis be used for that purpose as well?
Oh, absolutely. Risk management, it involves identifying, assessing, and mitigating potential risks, right?
Hmm.
And one study we saw, it looked into how risk managers at hedge funds use technical indicators.
Okay, so what did they find? Were those risk managers actually using technical indicators to manage risk?
They found that those risk managers commonly use technical indicators to evaluate and manage market risk.
Hmm.
And they also found that using technical analysis was associated with lower portfolio volatility and drawdowns.
So technical analysis can actually help protect portfolios from losses.
Exactly, exactly.
Yeah.
It's a reminder that technical analysis, it's not just about generating profits.
Right.
It's also about managing risk effectively.
Right. Right. Now, we've covered a lot of ground here today, but one last study that we wanted to touch on examined a pretty unexpected application of technical analysis:
Okay, I'm intrigued. What area did they apply it to?
sports betting.
Sports betting. Wow. Okay, that seems like a bit of a stretch to apply technical analysis to something like that. I mean, how do they even go about doing that?
Well, this particular study focused on using technical indicators to predict the outcomes of professional football matches.
Oh, wow. Professional football. Okay. And what did they find? Were they able to actually predict the winners and losers?
The results were actually quite fascinating. They found that indicators like moving averages and the momentum oscillators, they could actually help identify teams that were more likely to win or lose their upcoming matches.
Wow.
It seems that technical analysis, it can be applied to really almost anything where there's data.
That's pretty amazing. So we're not just talking about financial markets. We're talking about sports, potentially other areas as well.
Right.
Did they mention anything about any specific challenges or considerations for using technical analysis in sports betting?
They did. They found that the effectiveness of those indicators, it varied depending on the league and the specific time of year.
Okay.
Which makes sense. Different leagues have different levels of competition, different schedules.
Right.
And they also highlighted the importance of considering other factors like team news and injuries, just like in the financial markets.
Mhm.
You got to have that complete picture.
Absolutely. So this research suggests that technical analysis, it can be a helpful tool for sports bettors,
Mm-hmm.
but it's crucial to use it wisely, and in conjunction with other forms of analysis.
Right. So after exploring all this research, I think it's time to come back to that key question.
Mhm.
Do technical indicators really work?
Right. That was the whole point of this deep dive.
It was. And the answer, as we've seen, it's not a simple yes or no.
Right.
There's evidence to support both sides of the argument. Some studies have shown that technical analysis, it can be profitable,
Yeah.
especially in certain markets or certain time frames or asset classes.
Right, but other studies have found that it's really difficult to consistently outperform the market using only technical analysis.
Mhm.
And as we've discussed, those transaction costs, they can really eat into any potential profits.
Absolutely. One of the most important takeaways, I think, is that technical analysis is not a crystal ball.
Right.
It can't predict the future with 100% certainty.
Right. I mean, if it could, we'd all be billionaires.
Exactly.
But it can be a valuable tool for identifying those potential trading opportunities, for managing risk, and for understanding those psychological factors that drive market movements.
Right, right. And it's most effective when it's combined with other forms of analysis, such as fundamental analysis, macroeconomic research, and really an in-depth knowledge of the specific market or asset that you're trading.
Absolutely. It's about using all the tools at your disposal to really get that complete picture.
So what's the key takeaway here for you, the listener? Should you abandon your charts and just invest in index funds?
Well, not necessarily. I mean, the research suggests that technical analysis is most powerful when it's used as a complement to other approaches,
Yeah.
like fundamental analysis.
Right.
Imagine using technical indicators to spot companies with strong momentum, or to identify potential turning points after you've already done your fundamental research. Combining those different perspectives, it can really help you create a more informed and potentially a more profitable investment strategy.
Right. Right. Well, that's all the time we have for today.
Mhm.
But as always, we really appreciate you joining us for this deep dive into technical analysis.
Yeah, it's been a fascinating discussion.
It has. And we'll see you next time.
Until then.